Hey guys, Michelle Kinney here. Thanks for checking in. Thanks for checking out my video. I'm gonna do a quick video on selling a covered call. Super easy, super low risk. Stay tuned. So selling a covered call just means that you're selling a call and it's covered, meaning that you have the stock. Here's what I mean by that. It's super easy. Let's use Apple as an example. Apple's a great company, and right now it's trading for about $210 per share. So what you do first is you buy 100 shares, right? So when you sell a call or when you sell any option in general, you are really committing to either buy or sell 100 shares for each contract. So if I'm going to sell a covered call on Apple, first I'm going to buy 100 shares of Apple. Now, I might already own 100 shares, but if I don't, I can buy 100 shares right now. Now, if Apple's trading right now at $210 per share, that would mean if I'm buying 100 shares, that would cost $21,000, right? So 210 times 100. However, you don't have to put up the whole 21,000. You can use what's called margin. So most broker dealers offer you the ability to use margin when you're putting a trade in. And what I mean by that, it's kind of like buying a house. Like if I were to go buy a house, most people don't put up the whole amount of money for the house, right? Most people put up a portion and then they finance the rest through a mortgage. Buying stock on margin is kind of similar. So in my example with Apple, if I'm buying 100 shares of Apple, right, and it would cost $21,000 if it's $210 per share, I might have to only put up, let's say, $6,000 or $7,000, and then the bank kind of floats you the rest, right? That's what that means. So first I buy the 100 shares of Apple if I have $6,000 or $7,000 in my account. I pay $210 per share, right? Then I can turn around and sell a call against my shares. What I'm doing is I'm taking in premium income, and for that income, I'm just promising that I'll be okay to sell my shares at some specific price before a specific date. So in my example here, I'm going to use next Friday. So today is Monday, the 7th of July. Most options will expire on Friday. So I'm not going to use this Friday in my example. I'm going to use next Friday, Friday the 18th, right? That would be the expiration. And today, that particular option, a $215 call, expired at, or closed rather, at $185 for that particular contract. What I mean by that is this. It means that between now and next Friday, if Apple is $215 or higher, I'm promising to sell my 100 shares at that specific price. $215. Now that's pretty cool because, hey, I paid $210. So that would mean if that happened, I would have made $5 per share. $500 because I have 100 shares, right? And for that commitment that I'm committing to sell my shares at $215, if it reaches $215 or higher, I'm paid $185. Now that's a premium. I get to keep that premium no matter what happens. It's kind of like this, guys. It's kind of like when you have car insurance and you drive a car and you have to have car insurance, right? And you're shifting the risk from you to the insurance company and you're paying the insurance company a premium, right? And for that premium, the insurance company is going to pay your claim if you smash your car. Let's say if you have collision on your car, they're going to pay to fix your car if you smash it. Now, if you don't smash your car, they keep the money, right? So they don't return that premium back to you. And this is kind of the same thing. So when I'm selling a covered call, a call against my Apple shares, if Apple is not $215 or higher between now and next Friday, I get to keep my shares and I keep the premium that I got, which is $185 in my example. So here's the thing, guys. Selling call is so cool, a covered call, and here's why. You could buy a good stock that you like anyway. Hey, Apple's a great company. I don't think it's ever going to go out of business, right? So it might hop around, go up and down, but over the long term, it goes up. So you can have 100 shares and you can actually create yourself cash flow for owning that stock on an ongoing basis. This is the key to option selling, guys. This is why it's so much better than just trading stocks. So let's compare it against like Joe stock trader who buys 100 shares of Apple. Okay, and it goes up and it goes down, but he can't actually sell any or use any of that cash that he creates from that that volatility on the stock, right? Until he sells his stock. When you trade options, you're capitalizing and you're creating yourself income on an ongoing basis. So cool. So let me recap that. And here's the thing, guys. I know this might sound confusing. It's kind of like learning a new language, maybe. Like, let's say you want to learn Spanish or you want to learn French or something. You know, at the beginning, it's kind of like, oh my gosh, I gotta kind of like try to remember like how that works. But how do you get good? You just practice. This is the same thing. It's not that hard. I promise you. It sounds confusing if you're a super beginner, but man, like, you know, keep watching these videos and it's going to keep impacting you and it's going to like help you to remember. So I'm going to break it down again. Selling a covered call is like this. Here's an example. I buy 100 shares of Apple. I pay $210 per share. That's $21,000 for my shares. But I don't have to put the whole amount of money up. I can use margin from the broker dealer. So I only have to have like in my example, it's actually like $6,300 in my account to make that trade. So I have $6,300 in my brokerage account. I buy 100 shares of Apple at $210 per share. I sell a call against those shares that expires next Friday with a strike price of $215. What that means is I'm just promising to sell my shares if the price of Apple reaches $215 or higher between now and next Friday. Now, next Friday comes, one of two things is going to have happened. It's going to be, the price is going to be higher or lower than $215, right? If it's lower than $215, I keep my shares. I keep the $185 that I got paid for the premium. And then I do the same thing next week. It's like rinse and repeat. If the price of Apple closes next Friday higher than $215, well, that's cool too. I sell my shares at $215, and that's cool because I paid $210. So I make $5 per share, 100 shares, that's $500, and I still keep the $185. So it is literally a win-win. I'm telling you, it's amazing. Check it out. Put your comments below. Be sure to like this video if it's helpful, and subscribe to my channel for new cool ideas. Happy trading.